All right, let's talk about stock options. I know, they sound super complicated, but what if I told you they really just boil down to a couple of simple, powerful ideas? Ideas that can totally change how you think about investing. Let's dive in.
So, the first big idea, and honestly, this is the one that gets everyone's attention, is something called leverage. Just imagine this: controlling thousands of dollars of a stock, but only for pennies on the dollar. Yeah, that's the kind of power we're talking about here.
No, seriously, let that sink in. What if you could control $10,000 worth of a company's stock for just 200 bucks? I mean, that's the price of a decent dinner out. This right here is the main reason people get so excited about options. It's all about amplifying your capital. It gives you a chance to ride a stock's wave without having to buy the entire boat. And this really gets to the heart of the trade-off. See, when you buy stock, you're all in. You pay the full price up front, and if that stock goes to zero, well, your money's gone. But with an option, your maximum loss is set right from the start. It's just that small fee you paid to get in the game. We call that the premium. Your risk is totally defined. You know exactly what's on the line. Okay, so if an option isn't actually a share of stock, then what is it? Well, at its core, it's just a special kind of contract. And like with any contract, the real power is in the details. Once you understand the terms, you've pretty much unlocked the whole thing. And this is really the key dynamic you have to get. It's a contract that gives the person who buys it a right and the person who sells it an obligation. A right to do what? Well, to buy or sell a stock at a price that's already set and for a limited amount of time. That's it. A right versus an obligation. So let's look at the two players here. You've got the option buyer. This is the person who pays that little fee, the premium. And what do they get for it? They get the right to exercise the contract. They get a choice. Then you have the option seller. They're the one who receives that premium, and in exchange, they take on the obligation. They have to fulfill the contract if the buyer decides to use their right. All right, so these contracts basically come in two flavors, and it's super simple. One is for when you think the market's going up, and the other is for when you think it's going down. They're called calls and puts. First up, the call option. This one's easy. If you are bullish, you think a stock is going to go up, maybe even rocket higher, you buy a call. It gives you the right to buy a stock at a set price. So even if the stock price soars, you can still buy it at that lower locked-in price. Just remember, call means you think it's going up. And on the flip side, you've got the put option. You buy a put when you are bearish, when you think a stock is headed for a fall. This gives you the right to sell a stock at a set price. So even if the stock's market price totally tanks, you still get to sell it at that higher locked-in price. So put means you think it's going down. Okay, let's just nail this down so it's crystal clear. If you're bullish, you think the stock's going up, you're looking at a call option. That gives you the right to buy. If you're bearish and you think it's going down, you're going to be looking at a put option. That gives you the right to sell. Up or down, buy or sell. Simple as that. All right, that's enough theory for now. Let's get practical. How does this actually work in the real world? Let's walk through an example of making a bet on which way a stock is going to go. So let's say you're looking at stock XYZ. It's trading at 42 bucks a share, and you've got a good feeling you think it's going up. Now, you could go buy 100 shares, but that would cost you over $4,000. Or you could buy one call option contract. This gives you the right to buy those same 100 shares at 42.50, and the cost to you, just a small premium, maybe 210 bucks. And here's the kicker. That $210 is the absolute maximum amount of money you can lose on this trade. Period. Now, what happens if you're right? Let's say the stock just takes off and goes way up. Well, that contract you hold, the one that lets you buy the stock at a lower price, suddenly becomes super valuable. And you don't even have to buy the shares. You can just sell the contract itself to someone else for a nice profit. This is that leverage we were talking about in action. You can get a massive return on that tiny initial $210 bet. Okay, but what if you're wrong? What if the stock just sits there or even goes down? Well, you just do nothing. Your contract, your right to buy at a higher price, is now worthless, so you just let it expire. And what did you lose? Only the small premium you paid at the start. That's it. Your risk was defined from the get-go. So up to this point, we've only talked about buying options to make a bet. But that's only one side of the coin. What about selling them? This opens up a whole different world of possibilities. It's less about making big bets and more about generating a steady stream of income.
And probably the most popular strategy for this is called a covered call. It works like this. Say you already own at least 100 shares of a stock. You can sell a call option to someone else. And for doing that, you get paid that premium we talked about. It's just instant cash right into your account. Now, there is a trade-off. You're agreeing to sell your shares at a certain price, so you might miss out on huge gains if the stock really takes off. But for a lot of people, it's an awesome way to generate extra income from stocks they were going to hold anyway.
Okay, as we start to wrap this up, it's pretty obvious that options give you some incredible power. But with all that power comes a very specific danger. A big one that every single beginner needs to understand. So let's just quickly recap the good stuff. The power. First, you've got leverage, controlling more stock for way less money. Second, risk management. You know your max loss right from the start. And third, yield enhancement, the ability to generate income on stocks you already own. All great things. But, and this is a huge but, options are not like stocks. You can hold a stock forever. Options, they have a built-in, and for anyone who's unprepared, a fatal flaw. And this, right here, is probably the most important thing to remember. An option is a limited life, decaying asset. Every single option has an expiration date, and every single day that passes, a little piece of its value disappears. It's called time decay. This means it's not enough to be right about where a stock is going. You have to be right before your time runs out. For an option buyer, the clock is always ticking against you. So there you have it, a toolkit for leverage, protection, and income. Options give you powerful choices that go far beyond just buying stock. But every single one of those choices comes with a ticking clock. You're not just betting on if you're right, but when. The question you have to ask yourself is, can you beat the clock?